Welcome back, you legends. I'm Dr. Cal, and I'm going to keep it short and sweet for this video heading into tomorrow post-market Nvidia earnings and discussing the setup in Bitcoin. So let's get right into it. The stock market today had a bit of a mixed day, what I would call an indecision day, right? S&P, NASDAQ, Dow Jones, all basically flat. Russell 2000 down. This tells us that market breadth actually declined today. Even without looking at the breadth chart, I can tell that breadth declined because the Russell declined. If we take a look at the stock market map, a bit of a mixed bag. Communication services, cyclicals are down, all the while semiconductors in the tech sector are actually up. And then again, if I take a look at consumer defensive, mostly in the green, utilities mostly in the red. That is kind of unorthodox to see utilities lagging and then defensives leading because they're both defensive. But it happened mostly because energy declined and utilities tend to decline with energy. And then we had tech and finance leading, all the while communication services, stocks like Google and Meta down, while cyclicals also down. So it's totally an indecision day, and that kind of tells the story today. I discussed this distribution pattern in detail in my last video. Please go and check it out if you haven't. But the gist of it is this: when the S&P 500 forms this bearish engulfing candle, again, this type of bearish engulfing candle, and then continues to make a new high just like it did recently, but the NASDAQ 100 fails to follow suit and make a new high just like it failed here. That usually indicates that the top has been made and we're now in a pullback slash consolidation process. I'll give you a few very clear examples, and I actually use this exact same method to determine whether to go long back into the indices, the Nasdaq and the S&P, and that this is just pullback, or whether something more is happening. So this is the S&P 500 up top. We had this multi-day bearish divergence. It formed a higher high Monday. Nasdaq failed to do the same. A very similar kind of setup developed as the market was topping in July. S&P went on to make a new high. The NASDAQ 100 failed to do the same. Now, I'll show you an example where the NASDAQ actually led the market and made a new high, and it happened right after that October bottom. We had this bearish engulfing candle. Then the next day, the NASDAQ made a new high that invalidated the bearish candle, and then kind of the same thing happened here. S&P failed to make a new high, but the NASDAQ made a new high that is exceeding the bearish engulfing candle high the very next day. That told us that this bearish engulfing candle was in fact not confirmed. It meant that the market completed the reversal and was now, or I should say, completed the pullback and was now ready to move higher again, completely rejected that downside move the next day, and the market moved higher. Now, the picture is completely different today, right? The NASDAQ failed to make a new high. It even failed to exceed the high of yesterday. It continued to make lower and lower highs, fairly similar to this bearish structure here. This tells me that the market has already entered that consolidation slash pullback phase. How deep, how bad it gets, that leads us to our next point, that is Nvidia. So let's get right into Nvidia. I already mapped out the expected move post earnings for you. The standard deviation expected move is $13 in either direction. That means 141.8 on the high end, 114 on the low end. That is the standard move. For the 2 sigma move, for the 95 percentile, 95% of the time the market will close somewhere in this broader range. So if I look at a normal distribution curve, we're looking at the 1 sigma, 1 standard deviation move. That's the 68% chance. And then we have the 95%. And then we have the 95% chance falling within this wider 2 sigma move. Here's what it looks like on the chart. That means 68% of the time, the price will fall between these 2 lines. Now, if we take a look at the technical structure for Nvidia, it is forming a consolidation pattern, very clear range with very clear highs and very clear lows. Typically, the way to trade a range like this is to wait for the breakout and then trade the breakout to the upside or the back test to the upside. So either you trade the breakout here, or you wait for the back test and then you enter on the back test. Same thing to the downside. You want to see a break to the downside, you enter on the break or the back test from below, and then you enter on that backtest. So how do I actually do that when we know we have earnings coming and then a big move happening post earnings like these prior moves? There's no way to do that with options. Your only real opportunity to trade something like this is to trade stock post market after the earnings report comes out. That's realistically the only way to do it, because in this case, it's impossible to place a stop loss because the next day, very likely, we will get either a gap down or a gap up. Now, let's take a look at the broader semiconductors chip makers ETF, the SMH. We got a 62% retracement. This means that we cannot exclude the possibility that this is just a counter trend move and then a larger move is going to come. Often the probability that this is a counter move in a longer term downtrend is excluded if we exceed the 78th percentile. Very rarely does the market rally or a stock rallies all the way to the 78th percentile and then come back to test the lows. That's fairly rare, but it's way more common for that to happen after we test the 62% Fibonacci retracement. So what does that tell us? That really tells us that there's absolutely no edge into trading Nvidia post earnings. There's no clear edge to the upside or to the downside. Some people will look at the stochastic, they look at it, it's overbought and it's going to cross down in overbought conditions. But that really doesn't matter when we go into earnings, because we were in overbought conditions back in May and Nvidia still gapped up and rallied higher. So really the trade in Nvidia has to happen post earnings. There's no way to call it pre earnings. You just have to be aware of the risk ahead of the move. Obviously, the longer term trend is still to the upside. However, the S&P has not exceeded these prior highs. This definitely puts a question mark on things. I still expect the S&P to exceed this high, even if we're putting in a longer term top. So the fact that it didn't tells us that the market is waiting on Nvidia to see what Nvidia does. So summary for Nvidia: trapped in a range, very big expected move post earnings. The trend is still to the upside, so there is still a bullish edge. The SMH index retraced back to the 62% Fibonacci retracement and then came back down. This means that we cannot exclude that this is just a backtest. Now let's get into Bitcoin. Bitcoin had this really beautiful looking cupping formation, went on to break out and form a higher high versus this prior high. We were talking about Bitcoin often rallying to the volume weighted average of the prior cycle high, and as soon as it tags it, it tends to pull back and then rally again. This has happened a couple of times here. We tag it, pull back a little bit, and then continue higher. Again, we tag it, pull back just a little bit, and then go back higher, especially after touching the bottom of this multi-week range here. This is a multi-week range that, in the grand scheme of things, does look like a very large bull flag. We're still consolidating, but generally speaking, if we tag the bottom of the range, the market tends to rally, form a cup, breakout, touch the VWAP of the last cycle high, pull back a little bit, and then rally all the way to the top of the range. Again, tag it, form a cup, breakout, pull back a little bit just below the volume weighted average, then extend and touch the resistance line. That was my expectation going into this. However, we did have a nasty breakdown. Unfortunately, it happened post-market, right after the market closed. Let me pull up the 1 hour chart so you can guys see what I'm talking about. Look at this candle breakdown, 5 p.m. Eastern time, right after the market broke, right after the market closed. This was a very typical pullback, post-breakout pullback that looked a lot like this until we had this kind of dump post-market.
It was at this moment that he knew he fucked up.
Full disclosure, I'm still long Bitcoin that I bought in here. I'm also long another name in the cryptocurrency space that I got in very recently on this breakout. So how do we trade something like this? Something that looks like this tends to worry me a little bit. I would be now looking to exit this trade on a counter rally that likely matches this prior high. So my original target was all the way to the upper edge of this bull flag, kind of like this, again, boom here. But now after I saw that breakdown, it happened on the stochastic before it rallied all the way into overbought conditions. It looks almost exactly like this breakdown, right? Consolidated for a few days, then it broke down. The next rally, it rallied back to the highs. It really did not exceed those highs by much. This kind of large breakdown now does flag a risk that this very likely next move higher will only either match or slightly exceed and no longer a high probability breakout to touch this prior high for Bitcoin. That means I'll be moving down my take profit to these prior highs and no longer taking profit at this resistance line, which would have meant actually a rally to about 68,000 plus. Now let's jump to the 1 hour chart for the S&P 500. We are now trapped inside of this range. It kind of looks like a diamond pattern, right? This diamond looking pattern where we had this climax and then the second attempt failed to produce a much higher high. It basically rallied back to these prior highs. Now we have a triple top in a diamond pattern, and it does look like a textbook topping process within a range. In this case, what to look for is a pullback all the way back to the bottom of the range. That means 555 for the SPY. And the next level down is going to be 547, potentially lower, but 547 to tag this moving average and this prior pivot level. It acted as support when we were above it. Then once we broke through it, it acted as resistance multiple times, even had this false breakout, and then we moved back down. So this is now a very clear pivot level. Pivot levels, again, act as support when you're trading above them and resistance when you're trading below them. So as of right now, 547 is going to be the major support level to look for. And then the minor support is 555. If we go further back and take a look at prior pullbacks, we tend to pull back to the long-term moving average, this purple line. In multiple rallies, the exact same thing happened, right? Rally, pull back to the long-term moving average, do it again. Look, many times. Kind of the same thing happened here. We exceeded it. However, we did hold this major supporting trend line. In this instance, the major supporting trend line that connects these prior lows actually coincides with that same moving average. So again, as of today, major support at 547, and then we have minor support at 555. Bulls really need to break above this range to reestablish the uptrend. As of now, the uptrend is on a pause, and usually the longer these ranges last, the more likely that they break, especially when it's been a while since we had a pullback and we haven't had any pullback for quite a while. Normally, we'd be looking at something like 2.5%, 2.7%, right? 1.9% in this case. In this case, we had a 2.7% pullback. In this case, it was 1.9. So if we assume just a run-of-the-mill pullback, that means about 1.9%. That means between 552 and then 2.7% would take us down to around 548. That's why 555 as minor support makes sense. And then once this range breaks down, we go down to 547 back to this pivot level. Now let's take a look at the 1 hour chart for the NASDAQ. The NASDAQ does look like it is forming a bull flag, right? Very clear looking bull flag on the NASDAQ. And if this bull flag does break to the upside, we'll be looking at a rally back to these prior highs. So 484 if we break to the upside. If tomorrow, on the other hand, we gap to the downside, that means we are not likely to see a breakout until and unless Nvidia rallies post earnings. That is now going to be the determining factor for a breakout in the NASDAQ. Otherwise, still trapped in a range. 547 level for the S&P is equivalent to 467 for the NASDAQ. That means if the S&P 500 pulls back all the way back to this key support level, I'll be looking for the NASDAQ to pull back to around 467, potentially slightly lower to fill this gap. However, large gaps like this in an uptrend typically remain unfilled until a much larger correction rolls in. So in that case, I'll be looking for that same pivot level, prior resistance here, then broke above it and held as support. That will still be in my book the key level of support to watch for the NASDAQ. If we get a breakout above this bull flag, look for a rally back to these highs. Now let's take a look at the economic calendar this week. Tomorrow post-market, we'll get the Nvidia earnings report. That means Wednesday post-market. And then Thursday morning, we're going to get that GDP estimate for the second quarter. And then Friday, we're going to get that dreaded PCE number. But as we all know, once you get that CPI number, PCE usually follows that CPI, and CPI was much better than expected. That means PCE likely to follow suit and come in cooler than expected, which is bullish in this case. Let's take a quick look at the fear and greed index, kind of trapped in this 50 to 60 range. We've been here for quite a while now, making lower and lower highs. That means folks are getting more fearful each month closer we get to that rate cut that is expected to take place in the middle of September, I think September 18th. As we get closer and closer to that Fed rate cut, we're seeing more and more fear. Market momentum kind of now moving sideways before making a new high. Market is waiting on Nvidia to make that next move. Stock price strength moved down and is now just flattening. We're not seeing that kind of strength come in just yet. Breadth expanded significantly, but it did decline today with the Russell 2000 declining. And then put to call ratio, we're back below 0.7. We've been at these lows for quite a while. It does not necessarily mean to short. It usually means we've hit a significant level in the market in terms of price targets, and we're kind of there. We're almost back at these prior highs. Market volatility did escape the market. The VIX, I almost forgot to cover the VIX. The VIX did decline today. That's because we barely got any move in the market. The market was flat. When the market is range bound, flat or rising, you see a decline in the VIX. So we did not have much hedging going on, not a lot of hedging activity today before Nvidia's earnings tomorrow post-market. This means the lack of a rally today is not because sellers are back in control. That means buyers are simply too hesitant to place bets back to these new highs till they see the Nvidia earnings report. I want to close this out with the S&P 500 futures chart. Typically in an uptrend in the futures, we want to buy after the stochastic hits oversold conditions, boom, like this, and then produces a bullish cross. Let me highlight that with the blue. Boom. This was a buy. Again, called the bottom almost perfectly. Again, kind of called the bottom. We had this consolidation move sideways. We did not really exceed this low much, so that was a good buying opportunity. Again, even in a counter rally, we called the bottom and then we had this counter rally. Now that we had a breakdown of this uptrend, this now changes the equation. And in this instance, you actually want to sell after the stochastic enters overbought conditions. That means this example here and this example right here, those were opportunities to exit. Once again, after we reestablish that bullish uptrend, you want to use the stochastic as a buying, a bottom timing tool, a buying tool, not a sell side tool. So still kind of in the middle of nowhere here, no man's land in the middle. Consolidation slash distribution. We had a couple of big distribution days masked within this diamond pattern. The market now looks vulnerable. No buyers are to be seen, waiting for that Nvidia report, and the market is likely again a buy once we enter oversold conditions and produce a bullish cross on the stochastic. Hasn't happened quite yet. This means this is not a buy, not a sell. The market is just holding without a clear direction, with no conviction. You do not want to short a dull market. This is a dull market. You may want to short if this diamond pattern breaks down. I personally do not short uptrends. I just look for the pullback to be over and then go back long once that pullback is over. So for me, even if this breaks down, I will not be shorting it. I will be looking for a buying opportunity after the pullback is complete. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.